Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, and it is my pleasure and honor to bring back Jonathan Twomley for our weekly expert series. How you doing, sir?
I'm doing great, Michael. I missed you last week. I was on vacation with my family, so
That is awesome.
had a good time
Good,
upstate.
good.
Yeah.
Well, you know what? We got a lot of stuff to talk about. In the last 24 hours, we've gotten two kind of interesting macro decisions I want to talk about, and then, of course, talk about the economy, and then talk about what might be happening in multifamily, which is where you play. It might be happening in single family. So the two things are: we got a second Fed rate rise of 75 basis points. There is now, some people are thinking that the Fed's going to be slowing down or pivoting in the very near future. I am personally not in that camp, but would love to talk about that. And then just this morning, we got confirmation that Q2 is also negative GDP growth. So whether or not it's a recession or not will be for the academics to call, but we are shrinking 2 quarters in a row. So lots to talk about, lots to unpack. I will let you choose which one we go to first.
Well, why don't we start with the Fed rate cut? Let's do it in the order you laid them
Sure.
out. Fed rate hike and then the economy, because I think they sort of go in that order anyway.
Sounds good to me. So we got the Fed rate hike. I was fairly certain it was coming. In fact, I called it 6 weeks ago, got what I was expected. I now believe, again, I always like to try to call things early because it's fun to be right and sometimes embarrassing to be wrong. But I'm going to call a 50 basis point rate hike in September. So I think the market latched on to one phrase, Jonathan, and one phrase only in Powell's Q&A. And that phrase was really the simple acknowledgement that we can't keep raising at 75 basis points forever. Powell said, Fed rate hikes will slow down, which I think in his world was just an academic statement of fact. I think the market took that as like, oh my God, the recession's here. The Fed's going to stop. They're going to pause. I don't see it. So that's what I think is going on. What do you think was behind that 75 and what might happen in September?
Well, yeah, I mean, I think as we've discussed before, the Fed continues to want to send a really, strong message that they intend to fight inflation. They're not going to I think they want to err on the side of, I mean, even though Powell has said they're trying to engineer a soft landing, they're also at the same time trying to get ahead of it. And I think maybe even err on the side of being a little too strong rather than too weak, because they figure, well, if they come in too hard, they can always ease up. Whereas if they're constantly behind, if they're just going cautiously, interest rates will continue to be too low to stem inflation, and inflation will get out of control. So I think that they're erring on the side of coming in, hard, fast, shock and awe. That's what they want to achieve. So I'm not surprised to see today's move. I mean, it was pretty widely predicted. And, I also wouldn't be surprised to see this coming again in September. Obviously, now we have 2 months to see what the effect of this is all going to be. So it's a little less certain than the last time around. But yeah, I mean, I would not be surprised to see further hikes. And frankly, as you and I have talked about before, the Fed, I think it's kind of universally agreed now that the Fed let low interest rates go on for way too long after the Great Recession. They botched that. They created, massive asset inflation. They fueled the divide between haves and have-nots. Like, they made winners out of everybody who owned real estate or could buy it quickly. They made losers out of the people who couldn't catch up, and they destroyed basically, the incentive to save. They created a lot of incentive to invest in bad stuff. They fueled the crypto nuttiness. Like, all these things they did with keeping interest rates too low for too long. And I think now the pendulum is swinging back in the other direction. They tried raising rates in 2018. We had the taper tantrum, as we've discussed before. I think they also realized that was a mistake, just because Wall Street got upset. What happens to stock prices does not affect the general economy at all, right? It's a really small proportion of the US population that even owns stocks. So if the stock market crashes, well, yeah, it hurts, but it does not affect Main Street really at all, right? So I think they realize that they've made a couple of big mistakes. They need to get interest rates back to a normalized level, and I think they now have the opportunity with inflation to go ahead and do that. And so I think they're going to continue to use inflation as a way to get interest rates higher. And frankly, you're going to see central banks around the world starting to follow, because they're going to have no choice, because their currencies are tanking against the dollar right now. So you're going to see other central banks, go and raise interest rates too. We've already seen it in Canada, because when we were in Canada a couple of months ago, basically everything was 20% discounted if you had dollars, essentially, right? And so you've got the yen at pretty much generational lows against the dollar right now. I think you're going to see the euro at parity with the dollar, right? I mean, you're going to see God, going by European real estate right now, frankly, right? I mean,
yeah,
if you have any interest in,
you had the stones to pull that off. That'd be good.
If you have any interest in European real estate, I mean, good, now's the time to go buy it. It's on sale for Americans, right? So, but yeah, I think that you're going to see continued rate hikes, for some time, at least one more, let's say. I don't think they're going to go on raising rates forever, right? They can't.
Yeah. Let me just kind of cut in there, because one thing I always like to call it, because again, I spend so much time here. I think they're going to raise rates. They have 3 meetings left in the year. We're going to get a rate raise at each of the 3. It's 50, 25, 25. Talk about calling early. That's what I'm calling.
I was going to say exactly that myself. Okay. Like, if they're going to do 50, I think they won't raise it 50, 50, 50.
No,
that'll
be too much too fast.
Yeah, that'll just put like a knife through the heart of the economy. But I think that that they realize that they can continue to raise and still be at historically speaking, low interest rates, right? Mm-hmm. So, and I know that everybody is. I mean, there's a lot of pain going on right now for sure. But a lot of that pain is like the expectations of investors who thought, well, I'm going to make a lot more money on this flip because interest rates are going to stay low, right? Stuff like that.
Yeah.
And you've got people who want to buy houses who are like, oh my God, I can't afford to buy anything. However, for folks like that, all they got to do is just wait, right? Because the market is going to adjust around these new interest rates, and they're going to be able to buy things more, at more reasonable prices. But the pain is being felt by people who were dependent on cheap debt. And one of the things that I read, was reading this morning, which kind of bleeds into our second topic about how this affects the economy. There was, I don't remember who said this, but some analyst was saying kind of the reverse of what you and I were talking about when the Fed cut interest rates to practically nothing during COVID. Right now, if we go back a couple of years, when COVID hit, the economy shut down, the Fed went gosh, all these companies out there are living on cheap debt. But now their income may drop precipitously. Now, in a lot of cases, it didn't happen, because we know what happened, right? So a lot of companies actually wound up getting cheap debt, plus having their sales go through the roof, because everyone's sitting around at home buying stuff, right? And they didn't really lose that business. People continue to work from home, whatever. But anyway, the thinking at the time was, oh my God, there's going to be a cascade of bankruptcies, because these corporations who exist on cheap debt are not going to be able to service even their cheap debt. So we're going to make it even cheaper for them to service. Now, what you're going to see is kind of the opposite of that, where, and I forget who the analyst was talking about this, but so many companies financed at really cheap debt rates, right? And they did it to do stupid stuff like buy back stock and make their own bonuses bigger, or, a lot of things, right? Just fund operations cheaply because they could. When they have to go to refinance that debt, their debt service costs now going to be 2 or 3 times higher, right? And that is going to create a lot of pain, right? And it's sort of short-termism that you see, where oh, hey, money's cheap, we'll go borrow it, and we're not going to think about the future, right? We're just going to hope for the best, but we'll make money now doing this. But now they're going to have to refi at much, much higher levels. And there's going to be a lot of bankruptcies and restructurings as a result of this. And the more interest rates go up, the more, the more pain there's going to be. I think some of your smarter companies may be biting the bullet, doing some prepayment penalties and locking in relatively cheaper debt now rather than waiting another 6 months or another year, right? But you're going to see that, and that is going to have an impact on the economy. Now, how big an impact that has, too early to say, but there's going to be pain associated with the taking away the punch bowl.
Yeah,
right, of cheap debt.
This is exactly that punch bowl analogy is the best one I have. I think for 40 years, Wall Street has been conditioned to know that the Fed put is there, right? If we get out of hand or we get over our skis, the Fed will bail us out. Hence, you had increasingly risk taking. I don't think you can do that with 9% CPI. I think there's a lot of people hoping CPI is still transitory. They're not saying that word anymore, but they're hoping half of that just falls away because of bullwhip or supply chain or whatever. I don't see it. I think it's far stickier than that. I actually think wage inflation at 5% is underreported because of the Great Resignation. I don't think that data on, hey, I quit job A, got job B, and made 20% more, that's not in that number. Wage inflation is simply, hey, I worked here, I used to get this, I still work here, I get this plus. So I think wage inflation is greatly underappreciated.
And just on this point of wage inflation, one thing that we could see that's happening as a result of the Great Resignation, right? You and I have talked about this before, where, in the context of rents rising much faster than wages are rising, right? And how can these rent increases be sustained if wages are not going up? And for generations, let's say 2 generations, if you could say generations 20 years, right? For 2 generations of workers, basically they got in the shaft, right? I mean, like wages have not gone up at anything close to like real inflation or anything close to sort of productivity. They've gotten screwed. The American worker is more productive than ever. They've gotten screwed because those productivity gains did not translate into higher wages. They just went to corporate profits. They benefited, the very top of the pyramid only, right? The shareholders and the top executives got all the benefit of rising productivity, and the workers got shafted, right? And the threat was always like, okay, well, we're going to move your job to Mexico. We're going to move your job to Asia. Screw you, right? And so now I think you're seeing like a what do you call it? The perfect storm of like reshoring, so that threat of like moving your job somewhere else isn't there to the same extent, right? There's also, the Great Resignation happening. And I think what I've also read, one theory is that now, like, the chickens are coming home to roost, that 40 years of basically pent up wage growth is now hitting all at once. Right.
Agree. That's exactly what I think's happening. I think wage inflation. A lot of people don't like my call that transactions are going to crash and prices will stay relatively flat for 4 or 5 years, and it's all because I think wages will inflate above trend for years, and then it will just make housing affordable again because it's price, rate, and income. A lot of these naive channels don't talk about wages. I think we get 5 years of true wage growth.
Yeah, and frankly, I don't really like the term wage inflation. Wage growth, I like better, because I think what's going on now is wage inflation suggests that, like, well, people are just getting something for nothing, or like, it's whereas this wage growth is like, it's because productivity has gone up and wages grow. And what's happened is basically you've had like the upper end kind of like stealing the wage growth from workers, and now that's all coming back to bite them, right? So the corporations are going to scream, obviously, about this. They don't like it, right? Because it costs them more money. Shareholders don't like it because it drives down profits. But for real estate folks, right, this is great, because there's nothing better than having your tenants making more money and being able to absorb rent increases without it really, I mean, they'll, grumble about it, but they can afford it, right? Because their wages are going up. So, it's great for real estate. And like you said, interest rates will go up, but it'll all sort of shuffle. it's funny. I know some going off on a tangent again, but like if the way that like whether you're profitable or not with real estate and whether you like what's going on or not really depends on how long your view is.
Correct.
Right? Because if you're looking at like right this very second, well, yeah, there may be some pain associated with some of these changes, right? But I defy you to go back in time and like find me like a 5-year period in US history when real estate investors didn't make money holding for 5 years.
Yeah.
Right? Like it doesn't matter when interest rates are 20%, people made money in real estate, right? When interest rates were normally at 8%, like when you and I were kids, when our parents got a mortgage, they were paying 8 or 9% for their mortgages, right? That was normal. I remember how excited my father was when mortgage rates went to 6%, right? Because it was, people made money in real estate in that environment, lots of money, right? It just depends. There will always be an equilibrium that will set. And if your time horizon is long enough, it really doesn't matter what happens with price fluctuations. The people it hurts are short-termers, right? People who are looking for the quick in, quick out, want to make money right away. Their time horizon is a year. People like that, because they're very sensitive to changes in interest rates, changes in prices. Like, but if you are a long-term investor, it's almost never a bad time to buy if your time horizon is long enough. Right. Yeah. I mean,
it's always the debt structure, right? It's when your debt structure comes due at the wrong time, you become a forced seller at the wrong time. And it's funny. I don't know if you know much about Canada real estate, but Canada and New Zealand are really set up for some pain, I think, because they use 5-year ARMs as their majority of their 5-year ARMs, 25-year AMs. And their rates are now up 150% where they were. So there's going to be people having forced to refi. Even rate and term refis, your payments are going to go up 50 to 60%. So they may have a cascading effect a la 2008 with forced sellers. I've read several articles produced by Canadian news organizations that are saying somewhere between 25 and 35% of Canadians believe they will have to sell their home because when their payment resets. You do that into a flat or falling economy with more and more inventory, that gets ugly really, really fast, a la 2008.
So then Americans with your, buying cheap loonies and cheap real estate at the same time could be a big, big win for you. So,
yeah. So then let's just get back to the last one on the economy as we wrap up episode number 1. I think it's very clear, at least from where I sit, the economy is slowing very fast right now. It hasn't really shown up in the economics data. We've got some taste in earnings, Walmart, Black & Decker, other kind of Best Buy, kind of saying, hey, the consumer is pulling back. Even Chipotle is saying that the lower end consumer is pulling back. I'm willing to agree that we're not technically in a recession today because of the 4 factors that make up a recession were positive in Q1, Q2, but I don't think there's any chance we escape a Q3, Q4 recession. The consumer is crying uncle right now, I think.
Well, it is interesting though. I mean, one of the things I was reading this morning was the reason that there's some, usually the definition is like 2 quarters of negative.
That's a rule
growth.
Of thumb. As an econ grad, that's only a rule of thumb. It's worked 10 out of 10 times. It's a good rule of thumb, but it's still a rule of thumb.
But the interesting thing that sort of illustrates this point is that, I was reading this morning about how, well, yeah, we've had the 2 quarters of contraction, but we still don't really know if we're in a recession. And the reason is, well, jobs are continuing to grow. We actually still have job growth. Right?
2.6 million, 370,000 minimum each month. There's no chance the Bureau of Economics calls a recession. No chance.
Yeah. So that is continuing. People are spending money, but they're shifting, right, from goods
to services.
Right? Their hotels are doing really well, right? I mean, people are
Hilton. Yep.
Yeah. So, it's, and Michael, you called that before too, about people after things opened up, people were going to want to go do the stuff that they couldn't do before.
Exactly.
They bought all the stuff, right?
Yep.
So part of this is what's happened is that, people who are planning purchases, or so retailers, when they're looking at the economy, basically are just going to extrapolate, from where we are today. So when things went off the charts and people were buying stuff like crazy during COVID because they couldn't do anything else, well, the planners just extrapolated that out forward right now. But what happened was when things opened up, people shifted their buying patterns to other things. They started spending money on the stuff they couldn't do before. So now all these retailers are caught with all this inventory. And part of what you're seeing in this contraction is fewer orders, right? Because the retailers are
why buy more? You got some on the shelf.
Right, they've got all this stuff on the shelf that they have to sell down that inventory right now. So that's another thing that goes into this mix of, well, where are we? Because people are spending money, like they're spending money, but they're not spending money on this stuff. That hurts that hurts this part of the economy, but this part of the economy is booming. If you're in the hotel business, which I now am, you can't find people to work. Yeah. Right, because you got all this, your rooms are full, you got all this stuff going on, and you got to finding people to work is hard because everybody's got a job already, right? And so, and you've got these industry sectors where people, part of the problem with like rental cars is that the rental car companies went belly up during COVID. They sold all their fleets, they fired all their workers, and now they've got all this demand of like, oh, we got no cars, we got no workers. What are we going to do, right? So the COVID recession is going to be studied for years because you had like 20 years of economic stuff happening in like 18 months, right? And it's just totally it's going to be really, really interesting. But whether we're in recession or not, we don't know. Mixed signals. Maybe we will get the soft landing. Who knows? I still continue to think if we have a recession, it's going to be relatively mild because I think the fundamentals are still in pretty good shape. But we'll how much people pull back because of inflation, we'll see.
Very cool. Well, Jonathan, do me a favor. We'll wrap up this first episode with how can people find you?
Yeah, so people can find me a number of ways, but probably the most pertinent way right now, since I've got some active deals that we're doing, is at Two Bridges Asset Management LLC. So just Google Two Bridges Asset Management LLC. If you are interested in investing and you are an accredited investor, please fill out the investor form that you'll find there. I will get you on my list and you can see what I'm working on right now. We have a deal that is a 506c offering, which means for accredited investors only. So, stop on by. We've got some good stuff going on.
Yeah, what I would tell everybody to do if you're an accredited investor is do yourself a favor, get on that list, and then compare his analysis and what a conservative underwriting looks like versus all these other idiots with bridge debt, bad assumptions. It's night and day different. I am on many, many lists, and who a conservative investor is. So at a minimum, get on the list and compare. I think you'll be shocked.
Well, Jonathan? Also, I want to also just sort of qualify that by saying I am working with other partners as well, right? So, but the people that I work with have the same sort of conservative mindset that I do. So I don't partner with just anybody. I partner with a very select group of people, but they're also, when you look through the underwriting and the deals that I'm willing to work on with other partners, they're always very conservative.
Yeah. Do yourself a favor, get on the list and just compare. Just compare. It's night and day difference. I see 10-ish, I don't know, proposals or whatever they're called a week. And some are laughable. I mean, they're like, this is who the hell would throw money at this thing? So anyways, Jonathan, keep doing what you do. I appreciate you. I love your conservative underwriting. Thanks.
Thank you, Michael.